This is something that we're looking at. And, same-store sales were so weak in January. They were down over 2% for fast food, which we typically don't see unless we're in a recession. They were down 7.7% at casual dining. Investors are kind of looking past it, saying that the weather was really cold, but people still have to eat, right? And so so there's kind of some worry here for us, because like some of the economic indicators we watch, when you look under the hood, aren't looking great. So credit card debt is at an all-time high, 1.1 trillion. Credit card rates are at an all-time high at 21% APRs. Delinquencies have been rising for auto loans, as well as credit card loans, and they're now above the 15-year average and pre-pandemic levels. So there is some concern, but right now there's just so many variables going on with the weather, with the tough comparisons, and with these economic indicators to figure out exactly how much of this weakness is because of what, right? And so,
Yep.
but one thing we've seen is customers are dealing with the higher prices and with the higher inflation by putting it on their credit cards, which is not a sustainable situation.
Michael, when we were talking about the Capital One Discover deal, one of the things that was mentioned was how American Express is relatively immune from a potential slowdown. What are some of the names that you cover that if we do see the general consumers tightening spending, we'll be better positioned to continue to deliver sales?
Yeah, so interestingly, it's going to be a different consumer. So in what we've seen, one of the weakest segments has actually been fine dining, and it's a lot of that has been just a pullback in spending. People have been buying less expensive wines, cutting back maybe on appetizers. In a real economic slowdown, fast food and quick service tend to do better because they'll have value menu items. Discounts will be more prevalent, and so although you'll see a lot of low income consumers kind of trade down to the grocery store, the quick service chains will see a lot of middle and higher income consumers trade away from a higher price full service occasion and maybe dine at McDonald's a little bit more often.
Hey, Michael, talk to us about the labor situation in the restaurant business. I know for a long time, like a lot of industries, the restaurant industry had trouble getting labor. Where is it now?
It's full service is pretty much where it was prior to the pandemic. So think of Chili's and Applebee's and most of those casual dining chains that we cover, Cheesecake Factory. They're fully staffed right now. So they've recovered pretty nicely. Quick service has been slower. Turnover remains a lot higher, which is crazy to say because it was probably 140% for hourly turnover heading into the pandemic. Now it's probably about 170%. So they're having a lot more of a difficult time holding on to employees. That being said, it's been improving. It improved throughout the year last year. One of the toughest times to staff the store was that late night portion. But chains figured out it's supply and demand, and they have to offer more a higher wage to those employees to attract, good workers, and they've been doing that. And so that last kind of part of the day that was really struggling to hire is starting to come back too. So it's getting better. It's not where it was 2 years ago. 2 years ago was very difficult. There's a lot of people concerned that restaurant workers would never come back, but a lot of them have, and it's much better than it was.
Michael, to take the labor conversation and twist it just a bit, I was just in California for the last 2 weeks where minimum wage is going to be $20 in April 1st. Oh, went to In-N-Out twice, don't you worry. But so $20 minimum wage, I'm seeing a lot of these self-service kiosks getting rid of the kind of front of house, if you will, at some of these fast food chains. How does a higher minimum wage impact what these companies are going to do and impact their margins in turn?
Yeah, I mean, you hit the nail on the head. It's going to be more technology, and it's no coincidence that the companies that we cover that have the highest exposure to California, so that's Jack in the Box, that's Chipotle, they're leading the charge when it comes to automation technology. Right now, Jack in the Box is testing AI automated fryers. Chipotle has an automated make line that they're hoping to roll out in the coming years, as well as automated AI tortilla chip fryers. Right, so it's going to be more automation in the restaurant. But it takes time for that to be implemented because right now the cost for that automation technology is very high, right? But as as the wage rates continue to rise and as the price of technology falls, which it always does over time, eventually there's going to be an ROI, and a lot of those fast food workers are going to be replaced by technology.